Hello everyone, welcome to this new weekly chapter. This week's chapter, chapter 18, is going to be all about drawn liquidity. In this video, we will discuss everything that there exists about drawn liquidity. We'll discuss its types, its importance, and most importantly, how to actually determine drawn liquidity, right? All of these topics will be discussed in this particular video. I'll also make sure to show you as much example as I can so that you thoroughly understand the topic of drawn liquidity. This is an important topic and no one has really talked about it that much. So my objective in this video will be to clear all of the major misconceptions and confusions about drawn liquidity so that you finally understand and comprehend what does drawn liquidity even mean and what does it even stand for, right? First of all, we're going to start off with the introduction to drawn liquidity, what it is and what does it actually mean, right? Drawn liquidity, or its second name, directional bias, is about understanding and having an idea about knowing where the market is likely headed, right? And then identifying the most probable targets based on the time frame that you are looking at. Drawn liquidity or directional bias is the most important aspect when it comes to your analysis, right? And it should be your first and your main priority, right? With the help of drawn liquidity, you're going to have an idea about where the market is headed to, and that way you'll be able to accurately position yourself in that particular direction. All the other ideas surrounding analysis, like trade setups, entry models, and building narratives, revolves around having a clear directional bias and a sharp understanding of the market's drawn liquidity, right? If you don't know where the market is headed to, then no matter how much narrative you build or no matter how many entry models you look for, all of that would be deemed as pattern trading and illogical, because the first and most important thing is to determine where the market is drawn to, and only then you'll be able to do the rest of the stuff, right? All of the narrative building and entry models are dependent and based around having a clear directional bias and a clean drawn liquidity, right? It's the main prerequisite for and main requirement for the rest of the stuff. Without drawn liquidity, all of those stuff become redundant, right? And useless. Without having a clear directional bias, you're just simply pattern trading, which is the worst approach, right? And you should never conduct your trading in that fashion ever. Moving on to the next slide, right here we'll discuss what is the importance of having a clear directional bias and knowing where the drawn liquidity of the market is, right? The first and the most important thing about drawn liquidity is that it helps you understand what the markets wants to do and where the market wants to go and where it's likely headed, right? Rather than where you want it to go and where you are sensing it might go, right? This removes any emotional and sentimental biases and keeps your approach always objective and focused, right? And that way you'd always be mechanically in your approach, and you would conduct your trading and your trading decisions more informedly and more accurately. With the correct drawn liquidity, you'll always be correctly aligned with the markets, right? Which will respectively improve your trading decisions and trading ideas significantly, right? If you know what the drawn liquidity is, you'd be able to easily align yourself in the markets in that particular direction, and you'll make sure to only take entry setups or entry models that forms or that occurs in the direction of the higher time frame drawn liquidity, right? Knowing directional bias of the markets increases your odds and chances of success, right? And boosts your win rates by a huge margin, because after all, you are trading in the direction that the market is already leaning towards, right? And you're not taking counter trades in the opposite direction, which significantly decreases the odds in your favor. Drawn liquidity and directional bias acts as a filter for you, right? And it allows you to focus only on the trades in one particular direction and the direction of the drawn liquidity until there is a change in the market dynamics and the directional bias shifts, right? This way, for a specific period of time, you'll avoid half and filter out half of the market movements, which would be deemed inaccurate or lower probability for you since they are in the counter direction. It helps you avoid unnecessary, or simply you could say low probability setups that aesthetically look appealing at first but go against a market's natural flow, and that way you avoid trading them, which will help you avoid potential unnecessary and useless losses, right? Now, oftentimes we face entry setups or entry models that appear really appealing, right? And always has the best intricacies and detail. It follows all the confluences that you can think of, right? You even build the best narrative around it, but it still end up losing, and you lose the trade simply because the trade wasn't aligned with the directional bias or the higher time frame drawn liquidity, right? You can have the rest of the analysis as accurate as it can get, right? The entry setup might be the most appealing one and the best one you might have ever seen, right? And you might have built a really, really sharp and clean narrative around it. But you still must never take that trade unless it is in the direction of the higher time frame drawn liquidity and it's aligned with the higher time frame directional bias. And if that particular trade idea doesn't have this one aspect into it, then no matter how good the rest of the aspects are, it's not gonna work out, right? And it's always going to lose. Now, what all of that mean is that drawn liquidity is the most important aspect when it comes to your analysis and execution, and the rest of the stuff comes seconds to it, right? If you watch my trade breakdowns, then you would see that, and most of the trade breakdown, I mostly talk about determining ground liquidity and directional bias, right? That's the main reason behind it, because I know how important it is and what sort of important role it plays in my whole analysis and execution, right? I can have the rest of the stuff right, but if I don't have this particular aspect right, then all of that work and all of that stuff that I've done become redundant and useless, right? So the first and most important aspect when it comes to my analysis and your analysis should be to accurately determine your drawn liquidity and to have a clear directional bias, so that way on the lower time frames you can look for trades in that particular direction. Even ICT, if you watch his video, then you'd have noticed that in most of his videos he mostly talk about directional bias and determining down liquidity, and from that you can imagine how important it is, right? Now, I myself don't take any partials or scale into positions because I'm an intraday trader and I get in and get out within a day as soon as possible. But if you are a swing trader or if you are a trader who scales into positions, right? Who scales into position, then drawn liquidity significantly helps you with that too. If you have your directional bias correct, then you can put your stop loss at protected highs and lows and scale into position whenever you want. And that way, as price goes towards your drawn liquidity, you'd earn a lot more profits, right? It's a much more complicated system and process than this, and has multiple variables into it. But if you have the correct drawn liquidity, or if you have the drawn liquidity right, you can scale into position much more objectively, and that could be really, really lucrative, right? Now, another point is that drawn liquidity simplifies the decision making process, right? Your decision making process when it comes to analysis and taking entry setups and building narrative, and that way it reduces the number of opposing and conflicting signals and only allows you to act with clarity and conviction and trust in your system, right? If you know that the market wants to go towards that particular part and that particular direction, then if you take trades aligned within that direction, you would be a lot more content and a lot more objective in your approach, right? And you wouldn't panic, right? You wouldn't panic if price goes in your counter direction, because you would know that the bigger picture is showing my target and in the long term price is going to go towards that particular objective and that particular drawn liquidity. And in the short term we can have these retracement profiles and they're possible, right? So you would be a lot more content and comfortable in your approach, right? These are some of the importance of drawn liquidities and knowing where the market wants to go to, right? Just like I said before, this should be your first and main priority when learning and doing your analysis, right? All of the other stuff like finding entry models, building narrative revolves around this particular idea. And if you have this right and correct, then those other wouldn't be that big of a problem for you, right? Moving on. Now let's discuss the types of drawn liquidity, right? So inherently we have two types of drawn liquidity. Now, for most of you, this might be the first time you've ever heard that even drawn liquidity has types, right? But that's true. No one has really talked about it or even knows about these aspects, right? I've came to know and came to realize these types by my own research experience in chart studies, right? And in this part of this chapter, I'll explain what each type of drawn liquidity stand for and what are their core differences and what purpose each one serves, right? So the first type we've got is short-term drawn liquidity, right? And the second one, and the second type is the long-term drawn liquidity. Now you could probably guess by the name what's the core idea of each one, but remember it's not that simple, right? Each one of them has a bunch of intricacies and details into them, and you must be aware of all of them, and that would eventually lead you to making much more informed decisions about where you want to look for trades or where the market wants to go to or where it is headed to, right? Let's move on and let's start off with discussing the first type of drawn liquidity, which is the short-term drawn liquidity, right? Now, the simple introduction to short-term drawn liquidity would be that short-term drawn liquidity or directional bias helps you identify where retracement profiles, remember retracement profiles, right? Retracement profiles and shorter moves could go to and could potentially end. Simply meaning short-term drawn liquidity is used to determine where the market is initially drawn to in the immediate price action and the immediate time period, right? Now let me explain this to you. We all know that the market moves in profiles, right? There are five different types of profiles, and each one has a specific characteristics and a specific possible outcome when combined with key levels and dealing ranges, right? We also know that, let's say, if our target is higher or we are expecting the market to go higher to reach a key level on the higher time frame, right? Meaning that our drawn liquidity is higher. And the reality is that the market would never start moving towards that goal or towards that target straight away in an expansion profile or whatever, right? The reality is that it will move towards that goal or target or draw in different profiles and in a specific order flow. Even if the drawn liquidity of the target is higher, the market will still make retracement profiles in the opposite direction and still reject below lows in a bullish order flow or reject above highs in a bearish order flow, right? That's how the market moves. These retracement profiles are there to rebalance the expansion swings and to rebalance the ranges. We also reject below lows in a bullish institutional order flow to take out counter liquidity and to generate new one before moving higher, right? That's how the market moves, and that's how the market dynamics works. Now, I've taught you all of this in the order flow in the market profiles chapter, right? And till now, I'm sure you've learned it and you're aware that the market never moves in a straight line up or down, right? This is the most important conscious thought that you can have in your analysis. Now, that being said, let's say we determine that our draw or our target or goal for price is higher, right? Or to go higher to either take out a swing high or to reach a higher time frame key level, right? Or whatever reason it could be. The premise is that price wants to go higher and we've determined that. Now, your objective in that particular scenario would be to look for longs, right? But it's not that simple. You also need to be aware of the fact that even if the market or price wants to go higher, it will still make retracement profiles lower and make counter moves to reject below lows before it starts moving higher. So in that case, if you analyze price action and you see that we're kind of in the middle of nowhere, then the first thing you would anticipate and expect price to do is to make a retracement profile or reject below a low or retrace into a discount key level, right? You get the idea, right? And you would want to look for longs after price does either of these things, right? And being aware of this idea is important. You're gonna first anticipate a retracement profile so that price could rebalance that range or reject below low, and only then you'll look for longs towards that particular drawn liquidity which is higher. Now the purpose that short-term drawn liquidity serves here is that it helps you determine where those retracement profiles or where those counter moves in the opposite direction to reject below lows could end, right? This is what short-term drawn liquidity helps you with. It tells you and shows you where price wants to retrace to before expanding higher. And in that case, if you determine that the market first want to retrace lower before moving higher, then you can first of all look for shorts towards the short-term drawn liquidity, and once that short-term drawn liquidity is reached, only then you can look for longs, right? That is the idea of short-term drawn liquidity. I'll explain this with charts in just a minute. For example, when you are intraday trading, the short-term drawn liquidity helps show you or pinpoint where the market will likely make its first move, an initial move like a liquidity purge or a turtle soup or initial target before making the major move. Short-term drawn liquidity gives you clarity on where price might pause or reverse before continuing towards a bigger draw or the long-term drawn liquidity. Another huge point regarding short-term drawn liquidity is that it helps you gain more trust in your long-term drawn liquidity, right? Because when you are aware of the short-term drawn liquidity, you will know that these counter moves in the opposite direction are normal and you shouldn't be afraid of it, right? Let's say you weren't aware of the concept of short-term drawn liquidity, then what would have happened is that if price started moving in the opposite direction, right, as compared to your long-term drawn liquidity, then what would happen in that case is that you would start panicking and you would start getting afraid of those moves, right? And maybe that would even make you change your drawn liquidity, and your analysis would then become inaccurate or imprecise because you got afraid by retracement profiles. But when you are aware of short-term drawn liquidity, then you would know that it's completely normal for price to reject below lows and make retracement profiles before it starts moving higher towards the higher time frame objective or long-term draw liquidity, right? And you would start treating these counter moves as a rejection and rather than market structure shifts, right? And you would become a lot more aware and about the understanding of the market dynamics. Now let's move on to the next slide, and let's see some graphics to explain short-term drawn liquidity. So first of all, we've got this chart right here, right? You can see that we started out with testing a key level here and by purging below this low, and since then we've been moving in a bullish order flow, consistently making higher highs and higher lows. And we also see that the market is in a bullish order flow because it's rejecting below lows and breaking above highs, right? So in this case right here, you can see that we almost reached the drawn liquidity, which is higher, which is this key level above us, right? But what happened is that we came down lower a bit and now we're here. Now, if you didn't know about short-term drawn liquidity, then what you would have done here is that you would have straight away looked for longs from here. But since you are aware of it, you know that our first and immediate drawn liquidity, which is known as the short-term drawn liquidity, is this low right here. And first we would look for price to reject below this low to take out liquidity, purge and manipulate counter liquidity before expanding higher towards the major drawn liquidity higher. In this scenario, you would first expect price to purge below the low and reject below the low and then break above the high. After that happens to test the key level, right? That's what your first and immediate response should be. This is what we call short-term drawn liquidity, right? Even when our long-term and higher time frame objective is higher and that is bullish to reach the key level, even with all of that, we still look for longs and we still looked for lower price action because we know that the market moves in profiles, right, and an objective order flow before it could reach there, right? First it has to before it could reach there, first it has to reject below and to determine where the retracement profile could end. That is what we call short-term drawn liquidity, right? Let's see what happens. Right here you can see that what happened first is that price came down lower to take out the low and reject below it, right, and formed a retracement profile. And that retracement profile ended when we reached the short-term drawn liquidity, and after that price start expanding higher towards the long-term drawn liquidity. Now to some of you this might seem a bit vague, a bit vague, but let me explain its importance to you. Let's assume we are looking at the weekly chart right here, and these graphics that you can see represent the weekly time frame price action, right? Now from this, you can imagine and you could probably guess that each one of these swings that you see represent at least 1 to 2 weeks of data, right? And at least 200 to 300 pips worth of price action, right? Each swing represent that framework. Now remember that framework, right? Let's assume this is the weekly chart again, and each swing that you see represent 1 to 2 week worth of data and has at least 200 to 300 pips worth of price action, right? And that price action on the lower time frame, you can imagine, is a lot, right? So let's say you were not aware of short-term drawn liquidity, right? And you only knew about just drawn liquidity or directional buys. And let's say you determine order flow here and you saw that it's a bullish order flow and our next target is higher. So when we were here, right here, just like you saw in the previous slide, when we were here, what you would have done is you would have immediately started looking for longs on the lower time frame because you apparently determined your drawn liquidity to be higher. And throughout all of this price action right here that we made throughout this whole week, your drawn liquidity on the lower time frame would have been wrong because you kept looking for longs and you weren't aware that there is a concept called short-term drawn liquidity, which is the first priority for price before reaching towards the long-term drawn liquidity. So in this case, you would have been wrong throughout this whole week on the lower time frame, and your drawn liquidity would have been wrong because you expected bullish price action, when in reality, price first wanted to go lower to take out the short-term drawn liquidity to reject and purge below the low, right? Before expanding towards the major drawn liquidity, which is higher. This is what the importance of short-term drawn liquidity is, right? And that is exactly what most of you struggle with, right? That is why you keep having losses and incorrect drawn liquidity on the lower time frame and higher time frame, because you aren't aware of the types of drawn liquidity, right? And I'm 100% confident that this is the first time you are hearing about this concept, right? And this is the first time you have been taught this analogy, and that is the reality of the markets. That is what short-term drawn liquidity is, right? Knowing where price is gonna go first of all, to make its immediate short-term move before making a major move towards the long-term drawn liquidity. And then once that short-term drawn liquidity is reached, your priority then becomes the long-term drawn liquidity. Here is another example right here, and with this we're going to explain short-term drawn liquidity even more. So right here you can see that this is the euro dollar daily chart right here, right? And based off of that, you can probably assume that each one of these candles represent 1 day, right? Each candle represent 1 day worth of price action, and I'm sure we're all aware of it. Now based on this price action, you can see that the order flow is bullish and our long-term drawn liquidity is higher, which is this high. Now the order flow is bullish because you can see that price is consistently rejecting below lows and breaking above highs, which suggests bullish order flow. And in bullish order flow, our drawn liquidity would always be higher. So in this case, our main drawn liquidity or objective is this high right here that we are looking for to be reached. But you know that this is the typical drawn liquidity that you've heard and learned about, right? And you know that before price reaches that high, price first of all has to form a retracement profile and then end that retracement profile before making a major move higher, right? Right here you can see that we've got this low right here, and below that low is this order block in this discount region. So now we know that before price expands higher, it first has to reject and purge below this low and test the order block before it starts moving higher towards the main long-term drawn liquidity or objective. That this is what short-term drawn liquidity tells us about, and where the immediate and initial move could occur before the major move, right? Moving on to the next slide. At here you can see that what happened first is that price came down below to purge below the low to end the retracement profile there, right? And to reach the short-term drawn liquidity, to test the key level, to test the discount key level before moving higher. That is what price did there. It did not start moving higher immediately right away, but instead it ended the retracement profile there after rejecting below the low and testing the discount key level, and then after that it started its journey higher. Now, without the understanding of short-term drawn liquidity, you would have straight away looked for longs from here, and that way you would have been wrong about price and about the drawn liquidity throughout these days, and you would have had your drawn liquidity wrong on the lower time frame, and hence you would have faced losses, right? And then you would have been confused and clueless as to what happened and why that happened, right? And you would think that because you would think that you determine everything correctly, and but still price went lower, right? You would say that I determined that price wants to go higher, but still price went lower first, and that made me losses before moving higher, right? And by then I thought that maybe price doesn't want to go higher, and I took this rejection below this low as a market structure shift because price closed below it. And then after this point I started looking for shorts, and then price started going higher towards the initial drawn liquidity I had, right? This is what the thought process that most of you have in this sort of scenario, right? But now that you know of the short-term drawn liquidity and the types of drawn liquidity, you wouldn't struggle with this problem anymore, right? And you would be a lot more informed and accurate in your decision making process. Here is another example right here. Again, we've got this euro dollar daily chart right here, and you can see that based on range dynamics, we first of all took out the range low, and now we have to take out the range high, which is our long-term drawn liquidity. Again, in this scenario right here, those who don't know about short-term drawn liquidity would start looking for higher prices right away, and would look for longs on the lower time frame and look for bullish entry models. But we know that we are more informed traders, and we know that price always moves in profiles and a structured order flow. And before price could move higher towards the long-term objective, it first of all has to form a retracement profile to rebalance the range and test a discount key level, which would be our short-term drawn liquidity. Moving on, you can see right here that by dividing this whole range, we get this dealing range, and you can see the discount and premium region, right? And each one having its own respective key levels, right? And down right here, we've got a discount fair value gap. So now we know that before price expand higher, it first has to form a retracement profile and has to retrace here down towards the short-term drawn liquidity and makes it initial and immediate move before moving higher. And right here in this slide, you can see that even though our long-term objective was higher, even with all of that, we would have still looked for shorts throughout these 10 to 15 days. And once the short-term drawn liquidity was reached, only then we would have started looking for longs. If you had looked for longs right away immediately, then you would have been wrong throughout these 10 to 15 days, right? But since you knew about this concept, your decision process or your decision making process would have been much more informed, mechanical, and objective, and your priority would have been to first look for shorts and then longs, right? This is what the power of the types of drawn liquidity is, right? And I'm sure by now you would have understand the concept. Moving on to the next slide. Here is another good example right here on the 15-minute. So right here you can see that our long-term objective or drawn liquidity is this low right here, and let's assume we determined that on the higher time frame. So now you know that our objective would be to look for shorts off of here, right? But the answer is no, because first of all price has to reach a short-term drawn liquidity, and only then it will be able to reach the long-term higher time frame drawn liquidity or objective. Right here you can see that price first of all made bullish price action towards this range high in this CRT high or this candle range high to purge the liquidity, right? And to reach the short-term drawn liquidity before it will start moving lower towards the range low and the long-term objective. Short-term drawn liquidity must be reached before long-term drawn liquidity could be reached or the journey towards it could be started, right? And right here after that, you can see that we formed this model one order block entry right here. Price retraced to the order block, and after that, we started our journey lower towards the long-term trend liquidity. This is why it is so important to distinguish between what price want to do first and where it wants to make its immediate and initial move, meaning the short-term down liquidity, before it could make the major expansion towards where it wants, where it integrally wants to go to, right? Meaning the long-term down liquidity. Moving on, next up we've got is the long-term down liquidity, right? And in this slide, we're going to discuss what long-term down liquidity is, what does it mean, what does it stand for, and how to actually use it so that it can assist us in our analysis and execution. So long-term down liquidity is about major and significant moves and expansions, right? It helps you determine and see where price is heading in the bigger picture when you zoom out, right? Beyond immediate market reaction and movements, right? The reason we use this is for the understanding of knowing where price is likely headed to, where it is likely headed to, or where it could likely go, is a part of a broader narrative, right? Basically, it guides us on the larger moves on the higher time frames, daily, weekly, or monthly. Now, as we discussed earlier, short-term drawn liquidity is to determine where immediate market movements and reactions could occur and end, like retracement profiles and rejection of highs and lows. But on the other hand, long-term drawn liquidity deals with expansions and reversals, showing us where these broader and major moves could go to and where they are trying to reach for, right? It gives us a perspective on the bigger picture on the market movements and where it's likely headed to, right? Long-term drawn liquidity helps anticipate and determine where price could expand towards after it completes a smaller movements like retracement profiles and pullbacks, right? Which integrally allows you to target the larger liquidity pools and the higher time frame objective that a price is reaching for, meaning it'll help you anticipate and find the larger liquidity pools that the market wants to take out. Here is the summary. Short-term down liquidity helps you with immediate smaller moves in the current market profile, while long-term down liquidity guides you towards the major integral direction of the market and sets the tone and stage for major expansions and more broader narratives. And knowing about both of them are essential and important, right? Both are also essential depending upon the time frame that you are looking at and working with, right? Each particular time frame will have its own short-term and long-term down liquidity, and you have to determine it for each one, right? For example, a weekly time frame can have its own short-term down liquidity and long-term down liquidity, and then a daily time frame with its own two types of down liquidity, and so on. And you must be aware of all of them. Moving on to the next slide. Here's how you can establish and determine long-term down liquidity with order flow and market structure, right? This price action could be on any single time frame, it doesn't matter. If you determine the order flow to be bearish and you say that price is rejected below a high recently and made a retracement profile and that retracement profile is ended, then the next major down liquidity for you and that sort of price action would be the low that price formed, right? It's just as simple as that. The first round liquidity you would have is the low that price has formed, right? And these sort of places where price reject above highs, most of the time you'll find a CRT there at that swing point, which will initiate the top there and start the move down lower. And in that case, your first down liquidity would be to target the particular CRT low, and then once that is broken, that CRT or that candle range will be treated as an order block. Price will test it and then expand lower towards its major down liquidity, which is going to be this low right here. And moving on, right here you can see that after the rejection of the high in this bearish order flow, price expanded lower towards its major down liquidity, which is this low right here. There's another graphical representation right here, and in this one you can see that we've got a bullish institutional order flow. The reason we know that is that this is a bullish order flow is because price is consistently making new higher highs and higher lows. right? But also the most important aspect of that is that prices are also rejecting below lows and breaking above highs, which clearly suggests a bullish order flow and bullish market profile. In this sort of price action, the short-term down liquidity is always the lows because that's where the retracement profile could end. And when price reject below the lows to take out and purge liquidity, after that the long-term down liquidity is always the higher highs that prices made. And that's where the major movements would occur, right? After the immediate smaller movements like retracement profiles are done. Let's say this is the weekly chart right here and you're seeing the weekly times and price action. Then based off of that, you can see that each swing represents huge pips of size of data, right? And you can see what you can see is that prices reject below this low to form its immediate short-term movement to reach the short-term down liquidity. And now that the short-term down liquidity is reached and the retracement profile is ended, the next major down liquidity and objective for price is to reach the high, and along with that high, right, you'll always almost most of the time notice and find a CRT there or a candle range head at these rejection of the lows. And in that case, again your initial down liquidity would be to target the CRT high, and after that the next down liquidity would be the higher high price formed here. That is what your long-term down liquidity would be, and that's where the major expansions and major moves would occur. And moving on, right here you can see that price did indeed moved higher and expanded higher towards the high to reach the long-term down liquidity. Moving on to the next slide, right here in this slide we're going to discuss how drawn liquidity can present itself in different forms and what are the different various forms that a drawn liquidity can perpetuate itself in, right? We'll also see what are the different entities that could be used as drawn liquidity for our respective time frame. So we've got these different forms right here in this list which could be potentially used as drawn liquidity depending upon the framework that we are working with and depending upon how we are determining our drawn liquidity. The first and honestly the most important form of drawn liquidity is range highs and range lows, right? This is the main type of drawn liquidity and the most simple type, right? There are no complicated or complex intricacies or details into it, right? You just have to determine the range high and range low and then wait for one extreme of the range to be purged and manipulated at a key time. And once that happens, your next drawn liquidity becomes the 50% or the equilibrium of that range, and then eventually the opposing extreme or end of the range, right? The second most important form of drawn liquidity is CRT or candle range highs and lows. And you're always going to identify and notice candle ranges at swing points at range highs and lows. And in those scenarios, candle ranges will almost always guide you and give you a clear directional objective bias as to where price wants to go to, both for the short term and in the long term, right? So you must be aware of all of this as well. And you can use candle range highs and lows as your potential drawn liquidity on your respective time frame accordingly. The next form of drawn liquidity is higher time frame key levels, right? Now we know that market dynamics works in such a way that price consistently moves between higher time frame key levels, right? It tests one higher time frame key level and then expands and makes a major move towards another higher time frame key level. And both types of liquidity, both short term and long term liquidity, both initiate and end at higher time frame key levels. So based on this fact, you can use higher time frame key levels as your drawn liquidity for a more refined and objective draw, right? As where price could go to and to anticipate where price is potentially headed. Another form is discount slash premium of a dealing range. Now, if you've studied the dealing range chapter that I've made in CPI, then you would know that in every sort of market, there's always a dealing range and it has two halves, premium and discount. And then depending upon the order flow and market profile that you're working with, it can have two different qualities and characteristics, right? And if you're working with, let's suppose a bullish order flow, then in that case, your short-term down liquidity would always be the discount or the equilibrium region of that particular dealing range or expansion swing, and your long-term down liquidity would always first of all be the premium region of the dealing range or a key level inside the premium region, right? That's how you're going to use premium slash discount for a more refined drawn liquidity in terms of bearish order flow, right? Premium region would act as your short-term drawn liquidity, and the discount is your long-term drawn liquidity. Moving on to the next slide, right here we're going to discuss how to determine drawn liquidity, right? This is the most important part of this chapter because the rest of the chapter we discussed its intricacies and details and how important it is. But now in this part of the chapter, we'll discuss how to actually determine our different forms and types of liquidities and what are the different concepts that we're going to use that will assist us in that particular process, right? Now remember, the process might sound simple, but it has got a few details and intricacies to it, and you must be aware of all of them and then make informed decisions based off of that, and that will help you anticipate and determine your drawn liquidity, both short term and long term. Now, to determine your drawn liquidity, you would rely on and use the following concepts, right? We first of all use market profiles to assist us in knowing what sort of market profile are we dealing with, and second, we will use institutional order flow to determine what sort of market structure are we dealing with, right? Is it a bullish order flow or a bearish one? And we'll use candle range theory, CRT, or simply candle ranges, and combine it with the first two concepts and then integrate them with each other, and then it'll assist us in determining our major drawn liquidity. And then last but not least, we'll use range dynamics, dealing ranges, and key levels, or specifically higher time frame key levels, to help us anticipate or determine our drawn liquidity. Now, to understand each one of these concepts, you must watch the respective chapters I've made on all of these topics in CPI, and that way you will always be that way you'll be aware of the details and intricacies of each concepts, and you'll know and you'll be able to deal with it better, right? And you'll also be able to use them more objectively to determine your drawn liquidity. So make sure to watch those chapters first, right? Now, the two main and most important concepts that you'll initially use to gauge and assess or measure price with are market profiles and order flow. And then what you're gonna do is align them with high time frame key levels and dealing ranges. And when all of those are combined together with candle ranges and range dynamics at specific and key times, you'll always end up with a refined and objective drawn liquidity and a more accurate and precise directional bias for your asset or instrument, right? Moving on. So right here you can see that first off we got order flow. Order flow is the main component and concept which will assist us in determining our drawn liquidity. Once we have accurately determined the order flow, the rest of the analysis and process becomes easy, right? It's the most important and the main aspect that we have to determine in order to determine our drawn liquidity, right? We look at whether price is in a range bounded condition, and in that case we'll use the range dynamics and intricacies. But if it's not in a consolidation or a range bounded environment, then in that case you'll look and see whether we are breaking above highs and rejecting below lows, or breaking below lows and rejecting above highs, right? Those two aspects will tell you what sort of order flow are we working with, right? And what sort of market structure that the current market is in, right? And then just like I taught you earlier, you're going to use the order flow intricacies and target the highs and lows depending upon the framework that you're working with, and that will guide you on how to deal with structure and how to target both short-term and long-term drawn liquidity. Second one is market profiles, right? First of all, we know that each sort of market profile occurs at a particular place, and then each one, depending upon key levels and dealing ranges, has specific characteristics, right? And then their respective outcomes. For example, the only possible outcome after a manipulation profile is an expansion profile, right? And the only outcome after a ranging profile is either an expansion or a manipulation profile. And then we combine this even more with key levels, the possibilities narrows down even more, and we get a better idea of the market dynamics, right? Now, just like I taught you before, sorry, short-term drawn liquidity are used for determining where retracement profile could end, and long-term drawn liquidity are used for major expansions and reversals, right? So first of all, you're going to determine your order flow, and then after that, combine it with market profile to expect and determine what sort of market profile are we dealing with, or we could potentially deal with, and then based off of that and based off of that integration, you will determine your short-term and long-term drawn liquidity. For short-term drawn liquidity during retracement profiles, you're going to target highs and look for price to reject above these highs, whereas for long-term drawn liquidity, you're going to target and anticipate the major lows to be taken through and expect them to be the new draws and targets or objective for price. Next up, you're going to combine candle ranges with order flow in market profiles, and that'll help you refine your drawn liquidity even more and make it as objective and mechanical as it can be. At the rejection of highs and lows and a bearish or bullish order flow, you'll always find a CRT there, and you're going to match that CRT with a key level. And once that is passed at a key time, you're going to target the opposing end of the candle range first, and that'll help you determine your drawn liquidity in a much more objective, mechanical, and refined manner, right? For example, right here you can see that on this lower time frame we are in a bullish order flow, and what happened is that we first targeted and reached the short-term down liquidity, which is that we rejected below this low. And now that the short-term down liquidity has been reached, you can see that we formed a CRT there. And on the higher time frame, you can see that it's a lower time frame CRT within a higher time frame CRT, right? And with that, we also got this higher time frame order block that price is tested. So in this sort of framework, you can see that CRT, you're gonna target the opposing end of the CRT first once they are purged at key time, and then eventually target the highs. This is how you accurately determine your drawn liquidity with the help of order flow, market profiles, and its integration with candle ranges or CRT. Next concept we've got is range dynamics, right? Now, just like I said before, it doesn't have that much intricate or complicated details to it, right? It's pretty simple, but you just have to find the correct range bounded conditions or consolidations, right, in the markets, and then mark out the range high and lows correctly and wait for either side to be purged at a key time and for price to test a higher time frame key level. And once that happens, your first target first of all going to be the 50% of that range, and then eventually the opposing end of the range. And last but not least, we've got dealing ranges, right? Dealing ranges, just like you know, is an advanced concept that really digs deeper, even more into the types of down liquidity and helps you differentiate between the two and helps determine both types depending upon the premium and discount regions, right? We've got two types. First of all, we've got a dealing range and an expansion swings, right? And both are inherently different than each other in how they are formed, but they've got similar characteristics when it comes to function, right? Both of them got their own respective premium and discount region, and then based on the order flow, you can either target the premium region or the discount region, right? In a bullish order flow, your short-term drawn liquidity would be the discount region or a key level inside the discount region, and in a bearish order flow, your short-term drawn liquidity would be the premium region or a key level inside the premium region, and so on. Right here you can see this price action the order flow is bullish, and we've got this bullish dealing range right here. Price first formed this swing high right here, and once the swing high was confirmed, your initial short-term down liquidity would have been the discount region and then potentially this discount order block, and after that your long-term down liquidity would have been the premium swing high right here, right? This is how you accurately determine both types of your drawn liquidity. Here's another example right here. You can see how first of all we reached our short-term drawn liquidity, and then after that we targeted the long-term draw. You can also see the key levels inside of it. Moving on to the next slide, right here in this part of this chapter, we'll discuss how to actually integrate these concepts with each other to determine our drawn liquidity and how it's actually used, right? Just like I always say every time, knowing these concepts separately is good, but the actual action and function and purpose is served when we learn how to properly integrate them with each other, right? Knowing the integration itself is a detailed topic in itself, and it can't be explained right here in this video, and I'll be making sure to make separate multiple chapters on it but let me briefly discuss it here on how it's done. Once all of the concepts that I mentioned earlier are integrated accurately and logically around a logical framework, only then you'll be able to accurately and precisely determine your drawn liquidity, right? And for that, you'll use the if and then logic to assist you with it. For example, if the order flow is bullish, right? You have to first of all use the if matrix of the hypothesis. If the order flow is bullish, and if the fact of the matter is that we've rejected below a low, and if the market is in a retracement profile and it has almost ended, and if a candle range is present there, then based on all of these if metrics and hypotheses, the only deduction in outcome for price is to first of all target the candle range high is a down liquidity, and then eventually the opposing range high or swing high is long-term down liquidity, which means we'll have an expansion profile to the upside. It is the graphical representation of the hypothesis, right? Order flow is bullish. We have rejected below a low, and you can see there is a CRT or a candle range present there. So based on all of these, you can see our drawn liquidity first the candle range high and then the swing high based on this framework, right? And moving on, and right here you can see that price reached the long-term drawn liquidity with that framework, and we determined our long-term drawn liquidity by using all of the concepts like order flow, dealing ranges, candle ranges, and market profiles, and then we used and combined and integrated them with each other and used the if and then logic, which helped us determine our drawn liquidity, right? That's how you're going to do it. Moving on to the next slide. Right here you can see that long-term drawn liquidity is used for expansions and major reversals, whereas short-term drawn liquidity is used for the anticipation of retracements. Moving on. Now to see the examples of this whole process, you must watch my trade breakdowns and you'll see hundreds and hundreds of examples of me applying that process in the real markets and showing you how it works and how I execute trades based off of that, right? So make sure to watch those breakdowns for sure, and that'll assist you with learning this particular concept even more. Okay, that is what drawn liquidity is.